Hello and welcome back to The Note. The crisis in Europe in many ways seems to be over. We've seen rallies in peripheral countries' stock markets. We've also seen a tightening of bond spreads. But has that recovery train left the station at this point? There are some worrying signs. The euro is very strong at present, which is a problem for exporters. And you're also seeing very troubling lack of momentum when it comes to corporate earnings in Europe. So how do you play the European stock market over the next few months? With me now to discuss this is the head of thematic strategy at UBS, Karen Olney.
Hi,
Thanks
John.
very much for joining me again. Let's start with this rather concerning chart which you produced showing momentum in both margins and revenues for European companies. Particularly those red lines for revenue look really rather concerning. What's going on here?
Well, first thing to note is it looks as bad as it did in 2008, 2009 when we had a real heart attack in the economy. So revenues just aren't going anyway. That means the analysts are taking their numbers down, and I think again it's currency. There's a very high correlation to revenue, earnings revisions and what the euro is doing. And inflation is at a 10-year low other than the 09 blip. So you're not getting the pricing power and you're having to struggle with the euro. You're also getting a bit of kitchen sinking in the banks as we head into year end.
Okay, but there is some sense, this is consistent with the notion that we may not be having a financial crisis a la Lehman or a breakup of the euro, but we are going to get a prolonged period of disappointing growth, which could still be a problem for corporates.
Yeah, we're really shocked. I mean, the European equity market, the P's re-rated 50%. Everyone thought the profits would be back by now. This is the slowest profit recovery in 50 years. And we're not, Eurozone seems to be stabilizing a bit, but you're not seeing the company profits. So there's a bit of a lull in that we've seen economic improvement, but it's not showing up in these revisions.
Okay. Now, the other worrying thing that you've pointed out with this next chart is that we are very much primed for disappointment. Expectations are still for double figures earnings growth this year, and this chart shows you what's happened in previous years. It begins to look almost as though the earnings analysts are like Charlie Brown with the football. They keep expecting double figure growth and keep being disappointed. But what's happening here?
Yeah, it is extraordinary to see the analysts being sort of, I use the word wrong, they do their best, but to be wrong-footed 3 years in a row by more than double digits. In 2013, they've had to take their numbers down 17%. Right. And now 14 is starting to come down on the back of a strong euro. So we really believe you are going to get a kickback in profits, but we thought it might be H1, maybe it's H2 2014. So in the near term, there is a bit of risk that those earnings aren't coming through fast enough for investors that have bought into Europe on the belief of a strong earnings recovery.
Okay, so this means basically that it really is very difficult indeed to work out how to go about investing in European stocks at the moment. Now, one possibility that you produced here is to look at quality stocks that may not be that exciting, but that are a very good bet to sustain their performance amid problems. Take me through what this chart is telling us.
Yeah, absolutely. This is looking at it's stocks within sectors in Europe, and you compare the high quality performance versus the low quality. So this line is the performance of high quality stocks.
And that's determined by balance sheet strength.
Yeah,
and
return
earnings.
on capital, profit margins, balance sheet strength, a number of things. Exactly right. And what you can see is in a crisis, quality does very well. So when we were in the crisis, up until Draghi spoke, quality did very, very well, as it did in 09 when we had that heart attack. It sold off a lot, and our point being that quality is no longer expensive. So if we're a bit nervous, we're waiting for the earnings to come through, we're preparing ourselves for any crisis aftershocks, it might be a good idea to protect yourself with a little bit of quality, mainly because you're not paying up for it at the moment. Okay. And that would be an example of, say, Swedish banks versus Spanish banks, things that are seen as slightly higher quality at the moment.
So returning to the analogy from the beginning, the recovery train has left. The trade has happened, the profits are booked. At this point, it probably makes more sense to go back to the most reliable earners rather than to stocks that have been underpriced.
Until we see the earnings come back, nibble on quality when you're not having to pay for it. Absolutely.
Okay, Karen, thank you very much indeed. I think that was as clear encapsulation as you're going to get of a really very difficult picture when it comes to investing in European equities at the moment. Plainly, the revenue numbers in particular from companies are rather disquieting when you look at the overall implications for the economy. But it also seems very reasonable to expect that we should be getting a rebound in corporate profits before too much longer. Maybe moving into high quality stocks for the time being is a good idea.